Good morning, everybody. I'm Andy Kizik, Vice President of Advisor Relations at OTC Markets. I'd like to welcome you to our educational series at OTC Markets. Today's webinar topic is Accessing Investors, the Best Practices on the Road, with our guest speakers, John Hartwell and Jonathan Patterson, the founders of Harbor Access. Before we get started with the webinar, just a few housekeeping items I want to go over so we're all comfortable. First is all attendees on the webinar phones will be on mute. We want to thank all of you for joining the webinar. We'll get started in a moment. Any questions that you have can be entered into the chat box located on the bottom right of the screens, and we will address the questions at the end of the presentation portion of the webinar. Just one last item, which I'll repeat, is that there is an actual copy of the presentation on the site in PDF, which you can download, access, and mark up if you have for yourself and want to have any questions, so you don't just have to work offline. So we'll get started in just a moment. So if there's anything that comes up, it looks like we have a lot of attendees so far. I think right now what we'll do is I'll turn it over, and I'd like to welcome both John Hartwell and Jonathan Patterson, the founders of Harbor Access, who we've known for a while. Welcome, John and Jonathan, and thank you for joining us as our featured educational speakers. I'll turn it over to you.
Thanks, Andy. Thanks very much for the invite. As Andy mentioned, my name's Jonathan Patterson, one of the founding partners of Harbor Access. We are an IR agency and corporate access organizer. We focus on the small to mid-cap U.S. domestic companies as well as international. I myself have 20 years background both on the buy side and the sell side, and have ran several corporate access desks here in the U.S. I'll hand it over to my partner, John.
Good morning, everyone. My name is John Hartwell. Just to give you a quick background, I had worked prior to this career for 28 years with Volvo, everything from accounting, sales, marketing, strategy, treasury, and the last 14 and a half years prior to starting down this road, I ran the North American Investor Relations office for the group. So we're looking forward to a beneficial day. And with that, I will turn it back to you to start.
Thanks, John. So initially, when we were putting this discussion together for top tips on the road, John and myself have logged hundreds of thousands or maybe tens of thousands of miles together. And really, it's I guess it's been by trial and error that we've come across with some advice for our clients, and we hope to share some of those with you this morning. As you can see on the webinar, we've put together an outline, an agenda, and by no means is this everything that encompasses best market practices for being on the road, but certainly it's some of the what we found most relevant and important factors. As you can see on the first title, there is a MiFID II, obviously quite a hot topic at the moment. Differing opinions in the marketplace, how it impacts not only the corporates but also the buy side. And just very high level, so we're all aware of what MiFID II is. It's a UK legislation that's coming into effect in January 2018, and it's in essence an unbundling from research, buy side paying for sell side research, as well as execution or trading and corporate access. Going forward from January, the buy side have to pay for all external research that they receive from the sell side. And to give you an idea of how that is going to impact the sell side, T. Rowe Price came out and publicly mentioned the fact that they will have a budget of $4 million to pay for all external research. It sounds like a big number, but in the bygone days, that number was at least 3, if not 4 times greater than that. So it's going to have significant impact on the sell side. Again, research and trading execution will be unbundled, and they will have to have separate line items, and all of the buy-side funds will have to pay for that out of a separate pool of money from the investable assets that they have under management. I guess if you look at it, the glass is half empty, it means that there's a potential decline for small cap coverage from the sell side. As an optimist, I actually think that it's beneficial, and that the actual coverage that small cap companies get will be of a better quality. I think the corporate access that will offered to corporates will be of a better quality as well. Moving forward, so we can leave, I guess, the negative side, as some are calling it. We can move forward to shareholder analysis. Our view at Harbor Access is that a shareholder analysis is the best place to start, especially for the small and mid-cap companies. Essentially, you're taking a test of who currently holds your stock and how you compare with your peers in your sector in terms of investors that are holding your company. Most IR agencies should be able to offer this. And essentially, you take like-minded companies or companies that look similar to yourself in your sector or your industry and analyze who holds them and compare that. So, for instance, if you're an industrial company, you would take a basket of industrial companies with a similar profile to your own, and you would see which investors are holding that. And what that would highlight is that perhaps a shareholder is holding one of your competitors, but they don't hold your stock. That would be a target for you to go out and meet. Obviously, there are a lot of investors out there, so this is a great way to start finding investors that already have an interest in your company or sector. We can overlay that with fundamental analysis, which is slightly different in that we take the fundamentals of your company, whether that's your dividend, your market cap, your PE, earnings per share, and overlay that with companies that have a similar investor or fundamental profile to yours. This is a useful tool for companies that have successfully undertaken a few roadshows and identified new investors. What fundamental analysis does is it brings perhaps new companies or new investors, should I say, that wouldn't necessarily come up by just analyzing your sector. Obviously, we've mentioned IR agencies helping you with this, but again, you may have brokers or banks that are out there that have roadshowed similar companies to yourself. They're a great tool in terms of helping you navigate who you should meet with, especially if you're establishing an IR program for the first time. And as we've mentioned, the last bullet there is independent agencies can also help with targeting. And there are many great agencies out there that do this very successfully and do it much more sophisticated than I've mentioned this morning. Independent help. We find a lot of small and mid-cap companies don't really know where to begin and struggle with this. They're a little bit confused as they feel that they shouldn't necessarily have to pay for it. So there is free help out there as well as paying for it. What we hear often from our small cap companies is that should they pay for research? It can be successful, and we think that if you don't have a lot of coverage, it can be very, very helpful from the beginning. It at least establishes a line in the sand, if you like, or a starting point, and you can take that research with you on the road. It also helps to have independent analysis of your company and comments from an analyst that perhaps looks at your business from a slightly different viewpoint. Again, utilizing banks, if you have a bank relationship, feel free to use them. Ask them for help. They may be able to connect you with perhaps their trading desk to give you some information on trading patterns or activities within your sector. Obviously, if you have a broker relationship, this is a fantastic way to tap into their sales team, their research distribution network, And then obviously you have the likes of trading venues such as OTC. I know that the team here at OTC have immense amount of knowledge and experience, and certainly Andy and his team will be very, very happy to help guide many of you out there in terms of who to talk to and how to get help. Obviously, as an IR agency, we think that this is the best way to go about it, hiring a company such as Harbor Access. And again, it can be very cost effective in the long run. It helps establish a program. It helps you get off on the right foot. And obviously, a well-executed IR program can help enhance your stock price performance. The reverse of that obviously is true as well. A poor performing IR program can have a negative effect. And then obviously with the internet, there are a bunch of online resources that's there and free and available. And again, I have to mention OTC, the team here have a vast amount of knowledge and be very helpful. There are also publications out there, such as the likes of IR Magazine, that do a lot of thought pieces and white papers and can be helpful and at least give you an idea of where you need to be in terms of targeting your IR program.
When it comes to investor meetings, we put at the top, it's never too much. I think the biggest point there is you need to set realistic expectations. If you're just starting out, you're not going to walk into a room and suddenly meet with a contra fund. So the most important thing there is to prioritize your meetings. There is never too many meetings, especially when you're starting out. You need to get out and talk to as many people, whether it be within the industry, could be someone who knows your industry but doesn't know your company. They might use that as a read across, but at the same time, you're getting yourself on the radar. And the key there is whether they cover you or not, you can also be a good asset for them if they need to bounce off some ideas, whether it be company specific, industry specific, etc. The one very important thing is, if I could urge you, try not to cancel a meeting. Obviously, things come up in our busy lives, and having to rearrange things is an everyday occurrence. But if you do have to cancel a meeting, the best alternative is to give them some other dates and times in order to reschedule, as opposed to saying, I can't do it. That's going to leave too many unanswered questions there for a lot of the analysts in the community. The one that I always say is don't turn around any inbound meetings. Those are cost effective, whether it be a conference call, whether they're coming to your office to see you. Again, you're not traveling, you're not leaving the office. A number of the small cap, mid cap companies, CEOs, CFOs do a lot of the legwork. So to keep you in your office and still be able to meet with investors is a very effective way to do that. When you are doing a meeting, if I could point out one very, very important point is it is okay to say, I don't know that right now. If you were to turn around and try to make up something or whatever, you're hurting your company's credibility as well as your own. So to say, I don't know that, or if it's something that you don't disclose, remember, some portfolio managers and analysts, they get paid to ask you the questions that you might not want to answer, but at the same time, it's up to you to be able to either answer it, tell them you can't answer that because you don't disclose it, or just say that simply that I don't know and I'll get back to you. And I think that's the big key there. We all have various investors within the investment community, depending on where you are in the cycle, whatever. But I think one key aspect is to not be afraid of hedge funds. They do add some liquidity. They add some, you do have some company specific industry knowledge there. And with that, we can turn to the hedge fund page.
So again, this is the presentation's being put together from questions and issues that we've come across with our clients. And one of the biggest issues that we come across is that a lot of people that are new to investor relations, or indeed some of the veterans that have been doing it for a long time, are very wary about meeting with hedge funds. Personally, we think that hedge funds are incredibly useful, especially for companies that constantly get comments that we would love to buy your company, but unfortunately, you don't have the liquidity. Hedge funds can provide that liquidity, and perhaps they're not the longest term holders, but again, they're providing liquidity. As John mentioned, hedge fund analysts typically are sector or industry specialists, and the trend that we're seeing of late is that a lot of the hedge fund analysts and PMs are actually joining hedge funds from industry. So they're coming in as industry experts. Why is that helpful in IR? They're much quicker to develop a relationship than perhaps a long only that will keep you at an arm's length. Again, they're coming from an industry, so they know your business very well. Use them in terms of when you're meeting with them. Bounce ideas off them, as John mentioned. It takes a while to develop a relationship, but these guys typically will call you, and you call them, ask them, we're thinking of putting this in our presentation. Do you think it's relevant? What are your views? It can be a two-way dialogue. They also use them for sector intelligence. You call them up and say, we've seen this happening in our industry. What are your views on it? What's your take on it? It doesn't have to be a one-way conversation, and that you're calling and, we're going to come out and see you next quarter, and, we'll see you the following quarter. Ad hoc calls, check in with them. It's a lot easier to recalibrate perhaps your message within a quarter than leaving it until the next quarter. Small changes in direction are obviously much easier to make and have less impact than having to make a huge change to your presentation.
One of the hot topics that everyone kind of asks is conferencing. And I think one of the big messages there is there are subscription services that you can see for the month or for the calendar as far as industry specific, bank specific. And I think what you need to do is you need to plan in advance. You can't plan a month out. I think you need to go out 6, 9, even 12 months out to kind of see what conferences are out there, which ones you should attend, which ones you shouldn't attend. One of the benefits of the conferences is, as we put in there, it's kind of like speed dating. So to go in there, you might be able to see 10, 12, 15 investors, which would take you 3 or 4 or 5 travel days in order to see the equivalent. So it's a good use of your time and your travel expenses budget. The one realistic thing is when you're starting out, or even if you're established, again, everything is fluid. So things happen in a given day. You may not have a full schedule, which some people might view as a negative, but there are ways to utilize your time in a more efficient way, be it blocking out some time during the day, or you can also go outside and use the time efficiently, depending on where you are, to go out and meet other brokers, other analysts, or portfolio managers, depending on where you are geographically. So full schedule is not necessarily a bad thing. I prefer to view it as a potential opportunity for you. If you look at the industry conferences specifically, we're talking about industrials before, Mid-America Truck Show down in Louisville, you have biotech, you have ConExpo every couple of years for construction equipment. So those you can use. Again, those are good ways. People know the industry if they're attending. You might be new to the industry, but these people already understand it. So you're not doing a one-on-one. You would do a one-on-one as far as explaining what your company does and how you differentiate yourself. But these people already know. That's why they're attending the conference. So you're not fighting an uphill battle. You're starting kind of at the top and you're going downhill, if you want to look at it that way. So like we say, there are subscription services that will give you all of the dates, and whether it be sector specific, whether you're focusing on global, whether it's focused on North America only or EMEA, et cetera, et cetera. So look at that, plan your time away. Again, you as a smaller company, you have wearing CEO, CFO wearing multiple hats. So you need to kind of prioritize which ones are the best use of your time away from your daily tasks. But the key there is to not hide from conferences. They are an asset for you. If you look to presentations, and this is one of the key topics here, Do not feel the need to speak to every single slide. I think the key there is to let the investors, be it analysts or the portfolio managers, let them lead the presentations. You might walk in with 10, 12, 15 slides. I think prior to going into these meetings, the presentations, when you're thinking about creating the presentation, prioritize your top 3 messages. So you will put those in your presentation. You'll get that. The one other aspect within the presentations is to make sure you have all the pertinent information. It's much rather and much better to have too much information than not enough, because in a given day, you might have one individual who's meeting with 5 or 6 companies, so they can take notes and they'll be interested. But later on, a day or 2 later, their boss comes to you and Andy's asking me about company XYZ. Well, now you have the slides to go back, look through it in order to get the answer that you need. Plus, they can only write so much in a given time. So as I say, the key there is to make sure that you provide the information that's necessary. But again, you don't have to clear each slide. There's nothing more, I would say, detrimental. But then when the analyst or the PM sitting there and you can see their eyes glass over because you're literally talking to every single bullet point in your presentation. That's not a very effective use of their time. So to let them, as I say, be the cruise director makes them, obviously puts them in control, but it also allows them to ask the questions that are important to them because they might have a different agenda or topic. You can always answer their topic or their question, but you can also guide it back into your main messaging that you want to get through. The last bullet point there is you have to update your presentations. For some people, they will do quarterly updates. Some people do it monthly. It really depends on what you're doing. If you do give a forecast, the markets will hold you to that. So you don't think you can give a forecast for 1 quarter and then not do it for another year. Once you give a number, they will hang their hat on that number. So if you don't feel comfortable starting out, be it company specific, if you want to talk about industry, that's fine. They can back into that. But if you say you're going to deliver X, Y, Z, everyone will hold you to that. So once again, you need to feel your way through what's comfortable with what you want to disclose, what you don't want to disclose. But like I say, the most important thing is to let them be the cruise directors and use their time as efficiently as they can. You'll be able to get your message across, but it's better to have them in control.
We always started a meeting with just clarifying the amount of time we had. So, whether it's just to confirm we have 45 minutes or we have an hour, that way you can understand how to pace your presentation. And by doing that, you make sure that you get across the 3 points that John mentioned. There's nothing worse than being halfway through a presentation and the analyst or the PM saying, well, that's great. Thanks, guys. I've got to run to my next meeting. So it's okay to ask. It's okay to set to sort of set the timer going and it makes sure that you get across all the points that you want to get across. So essentially, it brings us to conclusion. Again, we try to keep it as brief as possible, but get across as many points. In terms of follow-up, we can't stress how important follow-up is. Again, if you say that you're going to get back with a question, get back with a question. Get back with an answer. You must ensure that you follow up. It's the thing that's most often overlooked by people that are out on the road doing the IR function.
And I think to JP's point, by following up, you're adding credibility. You wouldn't believe how many times an analyst or portfolio manager is surprised that you actually get back to them. They remember that, oh, company XYZ, they don't just take a question. They do follow up. They do answer my questions. And that's the key. As you said, follow up is the key. If you don't know something, find out the answer, get back. But follow up is all we can stress.
And then our other favorite is continuity. You say that you start to do something, whether it's you give guidance on a number, Once you do that, you have to keep doing that. And again, if you decide to go out on the road and you decide that you'd like to do that quarterly, then you have to keep doing it quarterly. If you stop for some reason going out on the road, analysts and PM will make up their own decisions as to why you have done that, and often it's a negative connotation. So again, follow-up, continuity, and follow-up.
Jonathan and John, thanks for that. It's Andy Kizik here. For those of you that have joined us in between, a copy of the presentation is available in the webinar as a PDF in the bottom, in case you need to get it. We have some questions coming up, and I think some of the questions we get, and one of the questions I have here is about research, okay? We as a company have no sell-side coverage. We're thinking about considering some pay-for research. Should we consider that? Because we really want to get our name out there, at least in some coverage areas.
Yeah, Andy, I mean, it's a question that we come across often. And what I would say is, if you have little to no sell-side coverage, it's a line in the sand, if you like, or it's someone taking an independent, albeit paid for independent view. But you can use that as a marketing tool. So for the small and mid-cap companies, I think it's a very useful tool. And we've seen a few companies of ours that we're associated with do that, and they've had much success with it.
And I think the one thing to think about when you're looking at coverage is you don't have one meeting and suddenly people are covering you. It's a long process. It's a marathon. It's not a sprint. So it will take a number of meetings. It will take time, but you just have to keep taking those meetings, because over time, you're adding credibility. You could be the one source, the expert. So depending on what the coverage universe is, depending on the financial situation, cost cutting, et cetera, like I say, it's not flipping on a switch and suddenly there's coverage everywhere. So you just need to remember that it is a marathon and it will take time to get there.
So John, would you encourage an issuer to go and try to get meetings with analysts, but critically ask, if you can't cover me, ask why, what is missing, what would I need to do if I'm getting started in trying to develop that?
They will openly tell you, listen, I don't have the budget. But again, if you don't ask the question, you'll never get the answer. So it's okay to ask the question. We had one of our larger clients, and for years they asked multiple banks why they didn't cover, and their answer simply was, we don't have the personnel to do that. So it is important. It is important to ask the questions, but I think again, it does take time, and don't be embarrassed to ask the question why.
We have another question that's come up, and this is a little more early in the stage, from an issuer who says, do I really need an IR program? And if so, how do I start to organize that? Where do I start?
So, yeah, well, every journey begins with a step. I guess to start an IR program, you've got to look at it. What do you actually want to get out from it? Do you want to increase your shareholder base? Do you want to diversify it? Do you want it to positively affect your stock price? There's lots of questions. And again, I think you start from what the company wants from, what do they want to get out of the IR program? So again, sitting down with an agency such as ourselves, we would sit down, we would set out some goals, and again, the goals can be as quick as 6 months, 12 months, 18 months, and then 2 years out there. And again, those goals all are changeable. But again, it's what do you want to get from the program? The program's for your company. So again, just sitting down and setting out some goals.
As a footnote to that question, there's always a budgetary concern for some of the issuers on getting certain things going first. Is there anything that you could recommend that a company that's just kind of getting their arms around the early stages of IR should do, or what should, with cost, how should they, what are some easy and quick things they might be able to start to do?
Sure. So again, if you are in the public space, so you're in the public domain, you will have some kind of banking relationship. Use that relationship. Again, as I've mentioned, Andy, we've given you a few plugs here, but the likes of yourself and your experience, use your relationships, your network. You'd be amazed at the amount of experience that you have there, and tap into that. That's free advice. Attend events, making yourself, make yourself more knowledgeable in terms of what's out there, what's readily available for free, and set yourself a budget. You've established the company. Look at where you want to spend the money. Again, I would say that setting those goals and setting achievable goals will have a positive impact on your IR program. So there's not one fix, unfortunately. There's no kind of magic trick out there or potion that will make the program. But again, set yourself achievable goals.
I've got another question coming up on conferencing, where an issuer might not be able to get easy access to a conference, but is it worth paying to attend a conference to jumpstart access to investors? And you talked about targeting earlier, so to put note to the question, maybe that's a way to get started. But the question is it worth to pay to attend a conference?
I would answer that absolutely. It is worthwhile. As I referred to, you might look at a one-time cost for a conference, but if you look at the overall cost to see that many of investors at one time, you're probably T&E, your time away from your office, etc. Is worth a lot more for you personally and your company than to go around again to see 5, 6, 7 different cities. So it is worthwhile. I do refer to it as speed dating at times, but you do get everyone in one location, so you can effectively see multiple funds analysts at one time. So if you do the math, it will come back to conferences are definitely a win-win for you.
Okay. The screens are lighting up with questions here. Here's the question. Do you believe there is a distrust of issuers' paid research? And do people assume that the research is biased because the issuer is paying for it? So I guess the interpretation here is, if I'm paying you for research, am I going to get a bias? Give me your opinion on that.
I think that with the industry changing, Andy, so let me answer it first. I don't think it's biased. It can't be biased. Simply that if it is biased research, then that analyst would lose credibility. And again, it all comes down to credibility. So the answer is, I don't think it's biased. This is a short-term answer. Again, I think it helps not to be derogative about the sell-side industry, but analysts have a herd-like mentality. So suddenly you have one analyst that perhaps picks up a stock and covers it, and whether, let's say that you've paid for the research, it makes it much easier for other analysts to see how that company is being analyzed. So in short, no, I don't think it's biased.
The one thing about that is if they do the third party, they become, if they're one of the first ones, they become one of the experts of the company. So that's one way for these independent research companies that they can drum up other business by people calling them and asking them questions about the industry or whatever. So it's a way for the research company to add credibility to their own company, as opposed to an outside company XYZ paying just for the research without any benefit for either of them.
Good. Just so our listeners are aware, OTC Markets has started looking at research coverage, and we have a research marketplace where we have looked at several providers of paid research on our website. So we've had inbound requests from research houses, and we have an internal vetting process because we try to bring better transparency to a lot of our investors who can better analyze value and trade securities, and we understand the difficulty of small companies getting research. So we have at the moment vetted 3 firms, Sidoti, Edison, and ACH. We have several others that we're reviewing, and this is one thing that we can do as a market to allow for small issuers to consider this as an opportunity where, you've got to build this process. I've got another question coming in, which is, what is a realistic budget for a micro cap company to set aside to start an IR program to yield some results? So, Jonathan, so I'm a small company, like I'm not, maybe it's a percentage of what I should put away, but I got to get started somewhere. Like, what's reasonable for me to get started? I think I had a question earlier that said, where do I get started? So,
Sure.
Why don't you, for somebody who wants to kick it off?
On the spot. I guess it depends on how active you want to be on that program. And again, the listeners are probably thinking I'm trying to avoid a number. It just really, there's again, it's IR. There's no one size that fits all. It's, how big is the company? It's a microcap company. How many employees? What is the product? What sector are you in? There are so many factors that are involved in that. But I guess, I don't know, John, in terms of a percentage, it just depends how active you're going to be.
Maybe the easier way to look at that is if we broke down the pieces of the IR program, if I had to go on the road to do a visit of 5 or 6 cities, I would then have to think about the cost of getting there and staying there and doing it. If I'm going to pay for conference attendance, whatever that price is, it's $5,000 or $6,000 to attend a conference. I'm not saying that is the actual price, but all of a sudden that goes there. If I have to work on organizing a small website to have a good IR information page on my site that will post a regular portion of my reportable, of my quarterlies, of my filings, of relevant corporate financial news, what will it cost me to do that? So in other words, if I look at these bits and pieces to get started, this is a lot of things that that anybody can go to at any time. And I would say the second part is, developing the message. When I think about message development, I've heard all kinds of numbers from small IR firms to large IR firms. And, how do you get ready for the story? You have to put a plan in place as an issuer. It's got to have who we are and will anyone care? What is attractive about my business? Is there value in the company or is there a change underway? And I think the key element for coming into this, and I'll come back to something else, is that if I'm the issuer, I have to take a very critical eye that if I were an investor, what would I want to hear from the company to invest in this company? What's important to me to do that, and then translate that for your own company. These little bits and pieces of the puzzle can make the process of launching and putting a budget together more manageable. And as an issuer, you might already be doing a lot of these things, but putting them in separate boxes to do that, there's a lot of services that we provide at OTC Markets that we can help direct you. What's it cost to organize a website, create it, and put it up on a monthly basis? There's service providers that can do that, and they're not expensive costs. We've heard costs of, a setup fee, maybe a few $1,000s, and then a monthly charge. So I think it can be done well under $3,000-4,000 to have it maintained. We've heard conference costs at attendance of $5,000 to $7,000 of attending a conference. Question is, which conference do you attend? And I think you've got to examine your industry, your sector, who the potential audience will be. If I'm a microcap issuer, will the investor want to take on that type of risk to go into that company? If I'm a 50 to 100 million market cap company with a decent flow, what are the parameters? So there's I think it goes back to the targeting effort and work.
Yeah.
And then there's the PR portion of it to have a consistent message. If you start down a path, maybe I need to hire or work with a public relations agency to help me formulate my messaging in a good corporate citizen manner to the street.
Yeah.
So,
and then also we discussed before, Andy, the fact that sometimes you don't need to say anything. Sometimes the best IR is nothing at all. So again, I think you're right. And then on the conferencing side, I would say, you pick a conference. I always go with the 60-40 rule, that if you do want to go out and you do want to meet with investors, the East Coast corridor is pretty cost-effective and efficient way to get out and meet investors. Even a day in New York would work incredibly well and be very, very cost-effective for you.
I think the other item to when you're looking at costs is executive management out of the office has your own internal costs. So is it worth leaving for 4 days when perhaps I could do a one-day event and use the other 3 days back in the office where perhaps depending on where you are in your business cycle, et cetera, it might make more sense for you to be in-house versus out-of-house.
I have another question that popped up here that has to do with our company has a few issues we'd rather not discuss with investors. Can we ignore these issues? I'm assuming they're a one-off issue, but what's the level of transparency that you would bring to the table with investors, and what's the strategy for consistency of making that information available to everybody, I guess?
I think that the answer there is no, you can't hide from these questions. As I said during the presentation, when you go in, you have your top 3 messages. You should also be able to have your 3 messages that you don't feel comfortable answering, but they might come up. So from my perspective, when things are tough, that's when people want to talk to you. That's when you should be more out on the road. When everything's great, that makes everyone's life easy. But when things are perhaps going down in a down environment or whatever, you can't hide from that. So you must address it, but it also gives you an opportunity because you can explain, this is what we're doing to address event XYZ or issue XYZ. So to try to hide in your ivory tower, 1, is going to send a bad message. 2, the fact that you're out there willing to take the hard questions, again, it shows that there's a lot of transparency between the issues and the company. And again, that's going to add more credibility than just sitting in your office.
John, do you think that trying to determine the materiality of that and addressing it as you have other news in a more public press release type way would answer a lot of questions, or should it be more reactive depending? In other words, how would you gauge, if we don't want to discuss certain things with investors, I guess you have to determine how material that would be versus not. And, I guess you don't want to air dirty laundry if it's bad, but do you want to address it openly in some kind of a press release, maybe attach it to something?
Yes, well, good old Reg FD, fair disclosure, is you can't say something to one person unless everyone knows that if it's material impact on your stock price. So doing it in a public announcement or an earnings call or something like that, absolutely. That protects everybody involved. That's the worst thing. And that leads you to the little internal lawsuits if you were to say something to one investor that could material impact the stock that no one else knows about. Look at good old Martha Stewart or whatever. So
you can't discriminate against your investors. If you put it out there, you got to make sure you get out there in the general open and address it. We've got time for one more question. I've got one question that's really I'd like to, and I saw it just popped up on my screen, is that it deals with the notion of social media. And the question I have, and I'll add a little spin to it, is what do you think about the many operations out there who offer social media IR programs targeting Facebook and Twitter? And, my spin to that question would be to add, how engaged should I be with social media for my business? I mean, it's a great question.
Yeah, no, and it's one that's becoming, we're being asked more and more. Again, it comes down to, if you decide that you're going to go down the social media route, then you have to keep doing the social media route.
You have to announce to people that you're going to be using that as a channel. Getting back to Reg FD, so if I'm going to use Facebook, I should probably say Facebook will be a general means of communicating with my, or Twitter.
Yeah. And again, you got to remember, even though that it's on social media, it's still regulated. So you have to be very careful what you put out there. To go back to John's comment about Reg FD, you have to be very, very careful. There are operations out there, and again, varying degrees of success. It doesn't make sense for perhaps someone that has a restricted budget. Possibly, it's a good means. It's a good way to get the information out there cheaply, quickly, and effectively. There are operations out there that do a very, very good job of that.
I think to be practical about social media, if you don't generally use social media, I think it's got to be embraced by the company to be used regularly. Because if you hire somebody to tweet or hire somebody to Facebook and then they go, the company has to embrace it. So I think a lot of these things sometimes are practical. And if you're going to continue down that path, I think it's there to remain important. I'm sorry, we're running out of time here, and we're going to have to wrap up. There's still some other questions we did not get to, unfortunately, but we will make an attempt to come back to those questions through maybe an email to them directly, okay? So I want to just thank Jonathan and John for giving us a really great overview, and there will be a follow-up and a copy of the recording available on our website. Our marketing team will be also sending a link for that as well. And again, the presentation is here. The presentation will be available. Do you guys have anything else to close out with?
No, just thanks. Thank you for the opportunity. And if we can help anyone, by all means, we're happy to have a discussion.
Thank you, John. And again, if any issuers have any questions, you can contact Bob Power or myself, Bob at OTC Markets or Andy at OTC Markets. We'll be happy to help and direct questions and bring answers to the table. Thank you, everybody.
Thank you. Have a great day.
Thank you.